Hello, everyone. Welcome to video 4 of chapter 3. Now, the last video was kind of a long one where we talk about taxable benefits. This video is going to kind of elaborate on that, have some examples so that we can try and gauge what's taxable, what's not. So going right into it, we're going to start with exercise 3-3 and 3-4. So during the current year, Jeffrey's employer provides him with a number of gifts and awards. Note that the Amazon gift card must be used for online purchases of Amazon only and not convertible to cash. Describe the income tax consequences for Jeffrey that result from each of the following gifts of awards. So I'm going to go down this list, then we'll go to the spreadsheet and I'll try and go through. I'm going to go down the list quickly, go to the spreadsheet, go down them in a little more detail. T-shirt with employer logo, $15. A birthday gift card, 75. Reward for exceeding sales targets, 400. A 10-year anniversary gift, a Seiko watch of 275. And then we have a wedding gift, crystal vase for 300. Personal fitness award, tickets to a sporting event for 250. And a holiday season gift, a food basket that was worth $150. So looking at this list, the t-shirt with the logo falls into those trivial amounts, those immaterial items. They want you to just wear the t-shirt with the logo. It's part of the company's swag. So because it's a trivial amount, this would be non-taxable. We don't have to include it in income. The gift card, because it's a near cash item, would usually be automatically included in income. But because it was for the birthday, a special occasion, can't be converted to cash and was only usable at the Amazon online store, this $75 is not immediately taxable. We have to consider it with any other gifts we've also received. So we will come back to this one. We hit a sales target and they gave us a reward of $400. It was just a reward for seizing. So let's say cash amount doesn't matter. We hit our sales target. We got a bonus related to it because it's related to our performance. It's directly related to doing our job. So that is a taxable benefit. It's part of the incentive to keep doing that job. We have a 10-year award of $275. So this is a gift. Now, gifts have a $500 threshold, sort of an allowance, but we get two of these. We get one $500 for general gifts, and we get another $500 threshold for time-specific gifts. So because this watch was because we worked there for 10 years, it's a time-related or anniversary gift. So we get to use this $500. And since it's under the $500, it's non-taxable. It's below our limit. And then we have three gifts. We have a vase related to our wedding. We got some event tickets for a fitness award. This is weight loss award, but fitness award either. And then we got a food basket for a holiday season gift. So these gifts have to be combined together to see if they get over that $500 threshold. So on their own, they would qualify as non-taxable, but combined, they get up to $700. So they're over the $500 limit. So this amount is taxable but only the excess of $200. That up to $500 remains non-taxable. It's only the amount that goes over that becomes taxable. So we would report that excess $200. So coming back to our birthday gift, our initial response is, well, it's near cash, it's taxable, but because of those parameters of it's only at Amazon and for our birthday, that we might have been able to protect it from our income, but our gift threshold is already over the $500. So there's no room to protect that gift card, so it too is going to be taxable. So we'll have to include that 75, the 400, and these $700. So combined, we'll have to add $1,175 to our employment income for the various benefits that we received. Let's go through it again with another set of benefits. John Nilsson is a sales employee of a high-end furniture store. During the year, John receives a number of benefits from the employer. Describe the income tax consequences for John that result from the receipt for each of the benefits, but we're going to ignore sales tax for the time being. $140 discount on merchandise that's regularly sold for $400. So 400 minus 140 means we're paying $260 for it. The merchandise costs the employer $200. Reimbursement of $2,000 in tuition fees for a course in creative writing. Business clothing with a value of $1,500 to be worn during working hours. John's employer requires all employees to dress professionally. A set of high-end dinnerware on the occasion of John's wedding anniversary costing $450, and a private healthcare plan for John and his families. The employer pays annual premiums of $780. The plan qualifies as a PHSP, a private health service plan. So we have another set of benefits here. The first one is a 35% store discount, that $140 that's coming off the 140. It's available to all employees, and they're still paying above the work cost. And furniture is not generally considered a luxury item, or at least moderately priced furniture is not a luxury item. So because it's still above the cost for the business and is available to all employees, this is a non-taxable benefit. The fact that we saved $140 is just a perk for us. Excellent. We don't have to report it on income. The tuition fees were paid for a creative writing course, but John works at a business that sells furniture. Unless he has a hand in writing up, maybe the catalog descriptions, there's not a lot of writing associated with his job. Because those tuition fees are not related to his work responsibilities, they're taxable. They paid for it, saved me $2,000, adds to my income. The business clothing of $1,500. Now, despite the fact that a lot of workplaces do require people to dress professionally, you have to wear a button-down shirt, tie, maybe a suit. That's going to be included in income. Even though your workplace requires it, despite being for work, suits are still often considered a taxable benefit because there's nothing distinctive about the clothing. A suit that I wear for work is also a suit I can wear to a nice dinner with my family. It's also a suit I can wear to a party. It's clothing that's available to me. Even if I'm only wearing it to work, it's not restricted to work. If I'm provided, now 1,500 is a lot, but if I was provided a work uniform, if I go to McDonald's and they hand me, a blue polo shirt that has the McDonald's logo on it, and they say every time you come to work, wear that shirt, that's more distinctive. It has the logo on it. It's required for work. So that probably wouldn't be taxable. But generally speaking, any clothes that your work pays for is more often than not a taxable benefit. For the anniversary gift, they got a gift of $450. It's under our $500, so that's non-taxable. And they paid the premiums for a private healthcare plan. Premiums are specifically excluded, non-taxable. Yes, just to double check one. I would like to go through a couple exercises as well in this video just to get out. So let's go back to the slides for a couple more slides, talking about tax planning considerations. Salary is a benchmark. It's fully deductible to the employer in year accrued, fully taxable to the employee in year received. Because the government wants to get their tax revenue, anytime you have a deduction in income from one source, it's often added to the income of another. So if I run a business and I sell t-shirts, when I sell those t-shirts, I make money, but then I spend the money to buy more materials, to buy more shirts. So that's a deduction that's going to be removed from my income in my business, but whoever I bought those materials from for the t-shirts, their income goes up by my revenue. So deductions usually have a matching increase in income somewhere else. So when your employer pays you money, it's fully deductible in their hands, fully taxable in yours. So there's usually this sort of symmetrical treatment. But because certain benefits have exclusions, we can get that asymmetrical treatment. The company will still get a deduction, but we won't have to add it to our income. So benefits deducted to employer and non-taxable to employee are often preferable compensation. I can still get the benefit without having to pay taxes on it. Anything that defers taxes, RPP contributions, not tax until benefit, is also a consideration. So if my work puts money into my RPP, they will deduct those amounts. I'm not paying taxes until I withdraw it. So in the year of the contribution, no inclusion to my income. So that's also a consideration. The first one saves me taxes. Second one defers my taxes. Complication with benefits that are not taxed to employee, but some items are denied employer deductions. So there are certain benefits like golf club fees where you might say, oh, it's for work, it's non-taxable in their hands, but the CRA wants to ensure that it's for work, that you're not just trying to finagle the rules. So they have explicitly denied club fees from being a deductible expense in a corporation's income. So your corporation might not be inclined to pay your club fees since they don't get to deduct it from their income. Employer cost not matched to employee benefit. This is we come into this when it comes to automobile benefits because the employer will pay for the car, but there's a specific calculation for your inclusion. So they pay for a $50,000 car, but your income tax inclusion might not be the $50,000, right? It has to do with this formula we'll get into next video. Calculation of employee benefit should include sales tax. If the employer is exempt from those taxes, the notational amounts added to benefit. Don't worry about that. We're not going to mix up your sales tax too much. But generally, if we give you a sales tax amount, we will usually add that to the benefit received by the employee. In this course, we will almost always add any sales tax stated to the benefit because the individual pays sales tax and I didn't have to. I saved the money. So if they bought me a laptop worth $1,000, they didn't just save me $1,000. They saved me 1,000 plus $130 of sales tax. So my benefit's the full amount, 1,130, even though my work was only out $1,000. Okay, just to go through a couple more exercises, so I can focus on automobile in the next video. So discussing including sales tax, Miss Vicky Corelli is, as a result of an outstanding sales achievement within our organization, is awarded a 2-week vacation in Whistler, British Columbia. Her Alberta employer pays a travel agent $4,500 plus GST of $225. What is the amount of the taxable benefit? This is straightforward. It's 4,500 plus 4,500 plus 225, but there is a factor here I want to address. Oh, here it is. Sorry, I think I might have gotten them mixed up on my. So the GST taxable benefit, the trip was 4,500, the GST was 225, so the taxable amount is 4,725. This is going to be included in income, but if this is actually, I was gonna say if it's a gift, we can subtract $500, but no, this says that it was a result of outstanding sales achievement. So we don't get the deduction. We don't get to remove that $500 threshold because it was related to sales performance. I did miss it. No. Yeah. Oh, there was a tax planning 3.5. Did I mix that up? I think I have my page. Sorry, I have some notes here with my page numbers, and I think I've mixed it up somehow. Oh, okay. So 3-5, planning employee benefits. As part of her compensation package, Jill Tyler is offered the choice of a dental plan for her family, an annual vacation trip for her and her family, or an annual birthday gift of season tickets to the ballet, from which her and her spouse are avid fans. The annual cost of providing each benefit is $4,000. So Jill has the opportunity to get $4,000 of benefit. How does she want it to come to her? Well, the dental plan is non-taxable. It is the one option that she won't have to add anything to her income. So that is a very valuable benefit. If for some reason she doesn't want to take the healthcare plan, perhaps her spouse has a healthcare plan that she's covered under, okay, then she'll maybe opt for the annual vacation or the ballet tickets. From a tax perspective, there's not really any difference between these two items because they would both qualify as gifts. And since gifts have that $500 non-taxable concession, she's receiving $4,000 of benefit, but she will report $3,500 in her income. And that goes for both of them because they're both the same situation. Okay. I think that's good for now. When we come back, we will discuss automobile benefits in the next video. Thank you for your time. See you soon.